Good Thursday morning, Market Chameleons and everyone joining us for the first time. Thanks for coming by and checking out the Market Chameleon pre-market show with the main man, all the way from the city of brotherly love, Dimitri Pragmatic. How you doing, D?
Good morning, Will. How are you?
Great. You want to start with disclaimer?
Yep. Good morning, everyone. Before we get started, keep in mind, Will and I, Market Chameleon, we're not a registered investment advisor. We're not a broker dealer. We're not telling you what to do. We're just sharing ideas. If you need professional advice, call your registered investment advisor or call your broker. That's what they're there for, to give you advice, provide you with guidance. There's a disclaimer. And
excellent. Seems like the CPI number came in a little lighter than expected.
Yeah, what was it, like 7.7, something like that, 7.6?
Yeah.
So the markets are basically recovering those losses from yesterday. But
yeah, it's interesting.
How looking over my shoulder to see what it was. Yep.
Those losses from yesterday, you think, because we had Rob brought up the question about FTX yesterday. Do you think it was related to FTX, or do you think it was, people getting in front of what they thought would be a higher CPI number? Combination of both?
Maybe a combination of both. I think that what happened to the FTX exchange in the crypto space, if you guys are following, it's all over the news, probably any forced sales that I could imagine would be in the crypto space, right? So those assets that they hold, are in the crypto space, and they might be there's probably a lot of forced sales yesterday going on in the crypto. I don't think people were forced to sell, their Apple stock or
Microsoft there are funds that are involved in investments, and so I just don't think
potentially there's probably some fear of a little bit of a spillover, but I think it was more. It probably had to do more with nervousness about the CPI number.
And the numbers are like I was reading this morning. There was recently a $900 million investment. Sequoia Capital, SoftBank, and they've already written it off to zero.
They think it's a total loss at this point.
Yeah, it was like, but it's like when it was a small, like we talk about trading, and when you place a trade, whether it's a stock or an option, it should only be a certain amount of your portfolio. I mean, 200 million for those funds is probably less than 2% of their overall portfolio, right?
Yeah, exactly.
It's not like they're levering up and investing in FTX.
The big loss was, I think, for Sam.
SBF.
SBF. Yeah, because I think that he lost something like 94% of his net worth. It's
amazing.
One day, the fastest.
Overnight, he went from paper wealth of somewhere between 16 and 25 billion, and now he's worth less than a guy who just won a lottery in California, or a girl.
Yeah, less than $1 billion, and he's got probably more problems heading his way. If you read, if you read some of the comments, that now there's concern that he misused customer funds. If that's the case, then you got legal problems, right? You got other issues that you're going to go, and now the SEC is looking at it, Department of Justice is looking at it, and we don't know for sure if that's happened, but that's one of the things that Binance said they didn't want to touch this. They cited that's one of the potential issues there, and that would be a problem for him. But look, he has an $8 billion hole right now that he needs to fill. So you got, your liabilities are much greater than your assets, and whenever you have that situation and the problems that he's having, finding a person or an investor to step up and bail you out is going to be very difficult. I don't think anybody wants to touch it, especially now you got DOJ, SEC looking at it. Customers want their money out. There's, I'm sure, going to be, lawyers now getting involved from all angles. So that's going to it's probably better. An FTX might be, a good technological foundation. It was working. That wasn't the problem. Not the technology was working, but that if that's what you're going for, maybe you just buy it out of bankruptcy at this point. Stepping in, it's going to be hard to imagine somebody stepping in and bailing them out with what's going on, with all the circumstances. But we'll see. It's all over the news. We'll see how that plays out. Let me share my screens. One of the things we do, if you guys have any questions, please put those questions on a live chat on YouTube. Will's watching it. He'll read them back to me. If you want to come on a show and ask your question live, we also provide a link to Zoom. Click on that link, takes you over to Zoom. Once you get to Zoom, click on raise your hand. When you do that, it'll prompt you to turn on your camera. You don't have to turn on your camera. Once we let you in, everybody could hear you. You could ask your question directly. What we'll do today, while we're waiting for any questions to queue up, I'm going to share my screen. We'll briefly take a look at the pre-market report, see what's trading in pre-market hours. After that, what I wanted to do was go to SPY and try to set up some option strategies using multi-legs to show different ways that you could use multi-leg strategies, combinations of options to not look just at a single target price, but a range of prices, because it's almost impossible to say, and I think it is impossible to say that I think the prices will be exactly at this point in this time in the future. And most forecasts, most estimates, predictions are looking at ranges, right? Like this is the most likely range, I think. And sometimes a range could be wide with a lot of uncertainty. It could get narrower. And what we'll do is maybe take, just for demonstration purposes, we'll go in there, try to pick out some ranges and how to strategize around that range. Okay, let's see if we could create a good risk reward strategy for, I'm gonna give it like maybe to the end of the month and see if we could optimize it to look attractive. All right, and I'm going to use the options profit calculator to do that. So let's start with the pre-market report. I'm going to try to go through it quickly, and then I'm going to jump to the SPY options chain. All right. So pre-market report, these are stocks trading in pre-market hours. We have our most active stocks, our biggest percentage gainers, biggest percentage decliners. Here I see 390 stocks made our percentage gainers list, 69 on the decliners. From this perspective, we're looking like a bullish bias at the open. Of course, that CPI number coming in lower than expected, starting to cool. Markets are looking for the Fed to, slow down or raising interest rates, perhaps even pausing with raising interest rates to look at, the incoming data. This number here, at least it's working favorably to that side. So we're up, I don't know, like 2 or 3%. What it looks like most of what we lost yesterday. Let's take a look at the S&P 500 stocks to see if we have a similar situation. So we want to take out ETFs, leverage products, closed-end funds, small cap stocks, units, rights, all that. We're going to remove and focus only on S&P companies in S&P 500. And I'm going to use this filter here in ETF. Let's drop it down. You have a list of ETFs that you could choose from. The first one is SPY, which is S&P 500 ETF. I'm going to click on that. And when you do that, the list below will filter out stocks that are holdings in SPY, which are the S&P 500 constituents. And here we see 108 stocks are on the percentage gainers list, 1 on our percentage decliners list. So from this perspective, again, looks like a pretty strong indication of a bullish bias at the open. If there are no questions, I'm going to jump to SPY to give it enough time to set up the strategies.
Perfect.
All right, SPY, that's kind of my go-to stock for demonstrations. And I'm on the SPY main page, coming down here on the left-hand side menu. Let's, under options, I'm going to pick the options chain. So here we have, where all the different calls, puts, options are organized. And on the left-hand side, I got these expirations. And these are when these options expire. I'm going to pick November 30th to give us till the end of the month. All right. So what between now and the end of the month, November 30th, let's click that. And I got now the options chain for November 30th. You see 14 business trading days left. Okay. So 14 actual trading days. And what I wanted to do was look at a multi-leg strategy. We'll start out with one that is more common, that you could hear, that you'd hear about. But in this demonstration, we're not looking for just up or down, right? A lot of people look at options just up or down. Like, I want to buy a call, stock's going up, or buy put, stock's going down. That's very difficult to do. It's easy to understand, and it's a simple idea. But in actuality, that's a very difficult strategy if you're not good at it. That's a difficult way to be successful, because you also have lots of risks in play because you got time decay, implied volatility, directional risk, got all those things by just owning an option. And here, let's kind of come up with a strategy where we think that the stock will fall into a certain range. Okay, so in a range of different prices. And how do you do that? Everybody can do different analysis. I'm going to just to pick strikes, I'm going to go through a simple analysis here, and you could get different types of models. And those models are adjusting actually to real-time data, but let's just keep it simple here to demonstrate the strategy. And here we closed yesterday at 374.22. Of course, in the morning it's different, but let's just ignore that for now and pretend like, it's still 374.22. And here's our at the monies, 375 strike. So if we're picking the strike that's closest to where the stock is. And I'll just pick, let's say 374. And then I got to come up, okay, where do I think the stock can be bouncing around in the next 2 weeks? That's what type of range can it bounce around? Is it a 1%, 2%, 3%, 50% range? And we could use volatility, we could use lots of different estimates, but over here, I'm going to come up over here and just take a look at historically. Okay, let's just ignore potential numbers coming out because I know CPI is coming out and stuff, but let's ignore that. Let's just use the historical numbers here. And we see that historically, the seasonality is telling us that between November 10th, which we're at now, or this was November 9th because that's where we closed yesterday, and the end of the month, November 30th, if we just look back in history, the stock SPY, the market, was up 75% of the time. 75% of the time, it did have a positive drift. So if we ignore any type of other numbers coming out or what's going on, and if we eliminate that, that's the historical drift. Tended to go up on average about 1%, 0.9%. Okay, how much did it bounce around, right? I'm going to hover over this, and you could see here, on average, when it was up, if we took out, you know, all the down moves and just looked at the up moves, on average, it was up 1.9%. If we only look down on the down moves, on average, it was down 2%. So you could see it's about 2% around that it moved around between November 10th and November 30th. So we're getting a kind of a sense of, you know, what range can the stock, you know, move around in. And you see the best move was 2.9% up, worst 2.6, so a little bit wider. It's not the average. Those are the best. We could also take a look at, you know, we know that there's going to be 14 days of trading left. And what usually happens over 14 days? So over a 14-day period, the market tended to go up. So one day up or down, but as you stretch it out, you know, a 14-day period tended to go up more often than down, almost 70% for an average gain of 0.7. So these numbers are giving us an indication that there's a bias towards the upside, right? And because of the average gains, and more often it does go up. And what is a 14-day typical period? If we took all the up moves and took the average up move up 3%, average down move down 4.6%. So if we just started at 375, right, and went down, let's just go down. What is, let's see, 2.5%, right? Let's say I think downside, it's going to be above the 2.5%. I'll start there. Okay. And below the 385, right? Another 2.5%, 3%. And that will give us this range. And we're going to say, well, then we think it's going to stay in this range, right? In this range. And if it does, then we're going to get to keep what we sold this strangle for, $9.14. Obviously, if it goes outside that range, we start losing. But, you know, I don't like to part with my money that easily, so I want to stop myself out. And to stop myself out, I'm going to buy the wings, because in case I'm wrong, I want to know ahead of time that I'm insured against something going wrong. Just like you buy a house, you know, you're going to buy insurance, flood insurance. You're going to buy insurance against it burning down. You know, you're gonna when you buy a house, you're gonna pay for an inspector to check your roof. You know, you're gonna pay an appraiser to appraise your house. So I need to go in there, and because, you know, I'm not a cowboy, I don't want to lose like 94% of my wealth in the matter of 24 hours. So I'm going to buy my insurance now and know my risk ahead of time. I'm stopping myself out now before anything bad happens. So let's go here to the upside, because I got unlimited risk right now to the upside, and I got unlimited risk right now to the downside till it goes to zero. So let's just say I'm okay. I'm going to buy this strike from 390 for now, and I'm going to do the same thing to the put, right? So we started at where did I sell the put at 365 over here, 365. It's lit up. I'm going to buy the 360, and here we go. This is my initial. So this is how it looks. If I'm right about the range, predicting the range, then I get to keep this $2.81 that we sold it for. If we're wrong and this thing just takes off, and my analysis, you know, was bad, I didn't anticipate something, I have to go back and look at my models again. What didn't I take into consideration? You know, oh, there was a CPI number coming out. I have to put that into my model, all that. But let's say we're wrong. My model, my assumptions are just bad luck. We're stopped out at 219 to the upside, stopped out 219 to the downside. So what are we doing here? I'm risking $219 to make $281. So over 100% return on the money at risk. So you could see here, now I'm aiming, what am I doing here? I'm aiming for more than doubling the amount of money I have at risk in a 14-day period. And the stock from here doesn't necessarily have to go up or down, just I have to be right about that range that it's going to bounce around. But that's picking the 374, right? So maybe I should move those strikes around. Maybe I should adjust my assumptions and see how that plays out. Well, this is telling me that the market tends to be stronger over that 14-day period. You know, either any 14-day period I look at history, or even just the calendar period of November, that for whatever reason, you know, supply and demand, more money tended to push the stock up and down. So maybe I start adjusting my strikes. Instead of 375, I'm going to shift this range. I'm going to shift this range up. So right now I got that, remember, I centered it at from 375. Let's shift these strikes up. So I'm going to use this, the strikes. And what if I shifted, you know, one strike, what's, I mean, 1% is like $3.85, right? Something like that. So I need to shift these by $3. So I go up one. That was $2. Let me see if I do one more. Okay. So I shifted the strikes up twice. Let's see how that works. I'm going to reload it. So now you could see I got a kind of a bullish bias to it now. So the stock now will go up as high as 388, 387. I'm still good, right? I have 200. I could make $269 if I pick the right range. If it goes down, I'm risking a little bit less, 131. But if it really goes up, you know, 331. So now, even though I shifted it up, right? If it really goes up, I got a little bit more risk on the table. 269 versus 331 at risk, right? And that's how we could start adjusting things. And maybe I'm not happy with that either. Maybe I wanted a little bit more, or where do I think it's gonna, you know, where do I think it's gonna top off? So let's take a look at where it's been trading recently. If I think it's just gonna be volatile, you know, I could take a look at the 20-day moving average. I don't have the VWAP here, but let's just say the 20-day moving average is right here around 375. So maybe the volatility will be around the 20-day moving average. So how far do I think it could get up or below the 20-day moving average? You know, we could use a resistance from there. I could look at the last 2 weeks high low. So in the last 2 weeks, it got as high as, let's say, between 390, 392, as low as 368, 370. So if I use that as my resistance, 390, 392, right now I'm at around 388. So that break even is 390, right? That's kind of the resistance we picked. We could change that a little bit more. I could shift it up a little bit higher just to make sure I cover that. So let's shift that higher. So at 391, we're still in the green. Right. So now this is the range. 278 to the downside, we're risking 221, upside 222. So you could see here more than 100% return as long as I'm right in picking that potential range. So now that we got the upside, that's the 2-week high. If we use that as the resistance, let me see the 1 month. 1 month, same thing. Okay, I'm not going to go to the 52-week high low because I know that range is going to be high. But if I just use these current numbers, I'm kind of right here on that resistance level, unless I think it's going to break through. On the downside, I got 350, right? So, that if we think it's going to break through that's the 1 month, 2 week, 370. So in the 2 week period, we're good, right? On that 2 week. If it hits that 1 month, then, we're down here. Again, you can move it around. The idea there is that, you have tools in front of you to start moving around those options, those strikes, to get yourself into a comfortable, where you feel comfortable that you're covering, that range that you're covering kind of fits into your outlook, and that the risk reward is acceptable, and this is kind of a wide range. Is it acceptable? It's up to you. It's, you got to decide how much you want to risk for the reward you want to take. But in this situation over here, we see you get, over more than double what you risk, right? On this situation, more than double. 278, you're risking 222 to make 278. You're risking 222 to make 278 here. More than double. Right now, the stock is in that range, even if, let's see if we open up. Now, I'm not telling you to do this, obviously.
Hey, D?
As a demonstration. Yeah.
We did actually a bunch of the chameleons were talking about how they track trades. People use Google Sheets, I guess Yahoo Finance as a tracker. Is there a way, if you wanted to track this trade, you could track it?
So, I think you can add it to your watch list. I'm not sure, but I think what it does is look. I have to see how the options right now track it, but we are working on a different trade tracker, but this will be in combination of integrating with some brokers. And we are talking to 2 brokers right now. We're going to start with 2 brokers, TradeStation and Interactive Brokers. We're going directly to them with our developers. So our developers are working, through their API system with their developers to integrate our systems. And when we do that, and get it integrated, if you guys, anybody who has an account with one of those brokers, will be able to link their broker. Will have a different section to track trades, and create benchmarks on your trading. So this way, it's very important to kind of benchmark your own trading so you know where to improve, right? So once we create that, you'll be able to get stats on your own trading and track, potential trades as well. And keep in mind that trading is it's dynamic, right? So it's not, I got to do this one trade and I got to wait till I'm right. It's dynamic. It's like, like playing chess or playing football, where things are changing, and it's your adaptation, right? That's what trading is. It's not investing. Investing is you're buying a stock, you forget about it, and you're giving it time, 2 years out, 1 year out, and trading options, or when you're actively trading, it's much different. You have a portfolio of risk. You should be diversified. You should be watching your risks, and sometimes your portfolio is dictating the trades that you should be doing. All right. But we're right up at 9:30. Will, that's a little bit further away. Again, it is something that we are working on. Side by side, integrating, and once you integrate and link your brokerage account, what what you can do on the Market Chameleon with that. So those are things that we are working on, but I would say that's further out because that really requires a lot of testing.
Awesome job, D, as always. Thank you, Chameleons, for joining us today. Have a great trading day. Great job, D.
All right. Thanks everyone for joining. Stay safe out there. Have a great trading